Hello and welcome to Gold and Silver Assets. I'm Diora and it's Sunday the 21st of February 2021. A short while back a viewer commented how in the first half of my shows I make a lot of sense, but in the second half of my shows not so much. And this is my response to that, and it's not actually what you might think. No, I'm not going to be defending technical analysis because I'm well aware of its various flaws. No, I'm going to argue that fundamental analysis is no less flawed. Absurd means ridiculous or extremely unreasonable. And be aware that I'm only using this word for dramatic effect. I actually think it's far too strong a word to use here. Why did I choose the word absurd? Well, back when gold was priced at, I think it was around $1,400-ish, one viewer said that my bullish analysis was junk and that it was absurd to think that the gold price would rise with all the banks shorting it. Well, we all know what happened next. Now, I'm not saying that to be smug. It could have gone either way. My point here is that nobody can afford to be rude or obnoxious about other people's opinions as far as the market goes. Sure, it's okay to disagree, but the reality is that no one knows the future with any degree of certainty. That brings us to the topic of manipulation. And we often hear people comment on how it's pointless analysing gold and silver markets because of the manipulation. My view, and I'm often asked about this, what I think of manipulation, yes, it's manipulated. I'm not going to argue about that. But then show me a market that isn't manipulated. The thing is that people tend not to complain when the manipulations are to the upside. Look, yeah, manipulation is unfair, but then look, so's life. I prefer to look at the practicalities of how to deal with it. Bashing YouTube content creators achieves nothing. You know, we're not superheroes that can come to the rescue of distressed retail traders. So the way I see it is there are a few ways of dealing with the problem of manipulation. One is that you could just join GATA, so that's the Gold Antitrust Action Committee, and you can either support them by contributing financially or by volunteering your time. Or alternatively, you could form your own organisation if you feel strongly enough. You might want to make your own YouTube channel to create awareness around this. And actually, commenting on other YouTube channels that are relating to gold probably doesn't achieve much because I'm sure most of us already know this stuff. It's actually the general retail crowd that really need to be made aware. Another option is to stay out of precious metals. But then again, remember I said that all markets are manipulated. So then some people might say, oh, well, then I'm not investing at all. I'm just going to stay in cash. Well, good luck finding a currency that isn't manipulated in some way. Another option is to acknowledge it and try and profit from it. And if you truly believe that manipulation is consistently to the downside, then surely you should make a killing shorting it accordingly. Look, I know it's frustrating, but at the end of the day, whinging and moaning about it doesn't really achieve anything. You've got to think, what do I want to achieve with this? Let's move on to the topic of financial and economic data. Someone once told me that if you assume, then it makes an arse of you and me. And economics makes all kinds of assumptions. There's a joke about the engineer, physicist, and economist, and they're all shipwrecked on a desert island with just a few sealed cans of beans to eat. How can they get to the beans? The engineer suggests using a rock to break the can open. The physicist suggests heating up the can in the sun until it bursts. And the economist says, let's first assume we have a can opener. Let's take the example of US debt, which is approaching 28 trillion. How accurate is this figure? In fact, how accurate is this chart? Well, I think as this figure rises, there'll probably be more and more rounding off, and probably it's going to be harder to track accurately. How rounded off is it? Is it to the nearest million, to the nearest trillion? And then, what if there are adjustments in the definition of the debt as, time has gone by? And if there are adjustments, that could mean that this debt is understated. You may have heard about the additional 21 trillion in debt that some allege is missing and unaccounted for. If that were true, then this chart would be way off. I therefore think that it's best not to get too hung up on precise numbers, especially with these official figures. But although this chart may not be particularly accurate, the information is still useful in terms of showing the trajectory. Similar criticisms could be made for inflation data. This chart shows the official consumer price index for the USA, and the definitions and compositions for this have indeed changed over the years, which kind of makes this chart absurd, really, doesn't it? Others have tried to remedy this by producing their own alternative inflation indices, but then arguments can be made about the inaccuracy of the alternatives as well. So here again, it's not so much the precise number that matters, but other aspects such as the trajectory. But also note that the differences between the two will compound over time. Another type of fundamental analysis looks at things like financial reports produced by companies, and this too, I think, has its absurdities. In most cases, I find that these reports tend to paint a very rosy picture, regardless of the situation, and it can be quite difficult for the retail investor to spot hidden problems. One example of studying quarterly reports being misleading is the Bre-X scandal. The movie Gold is loosely based on that scandal. The Bre-X stock price shot up from a few pennies to $286 and then collapsed to zero when it was discovered that the crushed core samples had been salted with gold. It was effectively a fake gold mine. Insider shenanigans can also occur in many varieties, and often they don't become apparent in these reports. But also honest mistakes can occur, and I've seen cases where geology assessments have been way off the mark. How can we minimise these risks? Well, the answer is by knowing the team. People like Rick Rule don't just sit in their offices reading reports. They're out there meeting these teams and sussing them out and keeping in touch to try and minimise these types of problems. Next, we have trading the news, which is something that many get on their high horse about. Price moved in this direction because this or that happened. But of course, that talks about things retrospectively and assumes direct causality. But looking at things prospectively, I find is more preferable. From this chart, this is the chart of gold in US dollars on the monthly scale. And we can see that after QE1, the gold price rose, and the same thing occurred after QE2, but then the gold price dumped after QE3. Now, it's very easy for anyone to be a genius in retrospect and come up with reasons why that happened. But were those same people predicting that effect before it actually happened? The gold price is driven by multiple factors, many of which are unknowable to us. And that means that predicting the effect of one particular piece of news can be very tricky. We had another recent example when Warren Buffett bought a chunk of Barrick Gold in August last year. And there were many who saw this as being very bullish for gold and were expecting a push up in price, at least in the short term. Although the gold price did move up a little bit in the days that followed, wasn't sustained, and the long correction that we've endured ensued. Now, look, of course, there are plenty of examples where trading the news has worked, but I'm just saying that it doesn't work consistently. Here's something interesting that occurs more commonly than you might think. The bars show a chart of GME resources with the ticker symbol GME, and that's on the Australian Stock Exchange. Now, I have absolutely no knowledge about this company. I don't know anything about its fundamentals, and I don't own or recommend this stock. Okay, this is just an interesting observation. The orange line shows the price of GameStop, which has the same symbol, GME, but it's just on the American exchange. But interestingly, notice how the timings of the price spike and drop coincide. I suspect that the Aussie stock went up purely because of its symbol. There are lots of similar examples of that, and that makes me think that when retailers start getting interested in silver, then any stock with the word silver in it will probably shoot up, even if the company has got absolutely nothing to do with silver. Finally, we have the subject of financial qualifications. In last week's show, one viewer wasn't at all impressed with my discussion of the etymology of bull and bear markets. He called my level of schooling into question and suggested that I wasn't qualified enough to analyse the markets. Sorry, sometimes it's hard to keep a straight face. Look, I don't believe that getting a certificate and letters after your name makes you better at profiting in the markets. Don't get me wrong, I'm not saying that financial qualifications are useless, no. But look, every industry, I think, has a spectrum of people in it. At one end, you have the hotshot superstars who are great at what they do. And of course, at the other extreme, you've got the cowboys and the charlatans. And yet they all have exactly the same qualifications. I'm sure you've all seen it in wherever you work as well. What I think really matters far more is experience in its many forms. Having practical experience in markets is hugely valuable. And of course, the longer the better. That does not require qualifications. In fact, I actually like to hear from people who freely admit that they had big losses early on in their experiences and that they learned from it and pushed through it. And subsequently, I'm sure they will have done very well. And in fact, in my previous video on bull market horror stories, we had a few people who actually said similar things. And, you know, I've got a lot of respect for that. Those are people that I like to hear from. I also believe that your life experiences can be useful in your assessment of the markets. So, for example, if your day job involves working with the public, there's lots of aspects of that experience that can actually help with your assessment of the markets. Being observant of what's going on around you can be just as valuable as poring over financial figures and reports. Jobs and hobbies that are outside the financial area also give you unique perspectives that can be of value. Overall, don't let anyone intimidate you with fancy jargon or qualifications, and don't let anyone tell you that you have no business being in the financial markets. They are wrong. In conclusion, I believe that any form of financial analysis has its flaws. There's no perfect tool. My approach is to look at the fundamentals, technicals, and what's going on in real life around me, and try to account for those flaws when making my assessment. I also try not to form my opinions based on any one factor. I just try and put everything together to form an opinion. However diligent you are, however much homework you do, it's common for something left field to come along and negate your analysis. It could be a geopolitical event, it could be a natural disaster, or more commonly, it could be the smoke and mirrors that occurs in the markets. Thinking of the markets in the same way as you'd think of rocket engineering or brain surgery, is a big mistake. Those are far more concrete disciplines. No, the market requires mastery of managing probabilities and uncertainty. And that's a lot more uncomfortable for most to deal with. I also think that there's way too much focus on what price does and not enough on the emotional reactions to it. Strong emotions cloud your thinking and impair your ability to react appropriately. Even if your analysis suggests that prices will rise and in fact they do rise and you are correct, that doesn't mean you'll necessarily profit from that rise. My video on bull market horror stories discusses that, of course, in more detail. But yes, financial analysis is full of absurdities, and all we can do is work with what we've got. Next up, the market update. Let's start with gold priced in US dollars on the daily scale. Well, this wasn't quite as boring as I was hoping it would be. We don't need this kind of excitement, do we? But look, we can take it. Yeah, I was hoping that price would go sideways, but the gold price isn't interested in what I'm hoping. Interestingly, so price did drop. And it's kind of stalled at this support area over here again. Will that hold? Hard to know. I actually think that it might make a little stab down. How low will it go? Well, there's a ton of support here at around 1750-ish. And I think that'll probably signify the end of this correction. But look, I don't know for sure. I mean, I thought this was going to be the end. But look, I mean, it's still pretty close. This is the kind of ballpark area that I'm thinking of over here. Worst case scenario, just below 1700 because of this trend line here, but it doesn't have to go that far. I think it would be quite a bit of work to break through this kind of level of price action. But yeah, let's see. But yeah, I think, if it bounces up a little bit, it could still trick people and just dip down again. But I think that will flush a lot of people out still. I know that I've heard a few people say that they would sell at around this kind of level. And of course, when you get a lot of people talking about selling, that's usually when the bulls pounce in and move things up. I'm still optimistic about the gold price. Remember that, I'm not great at, day-to-day or week-by-week price moves. I try and look at things on the mid to longer term. And I haven't seen anything that goes against that bullish case, particularly when you think that, look, this is the paper price here. And if you look at the way physical is going, it's quite hard to get hold of silver and in some places even gold, and the premiums for both have been creeping up. Now you might say, oh, well, silver, they had all the hype and stuff, but gold has been silently creeping up. Those premiums aren't going down and they're well above average levels still. So, there is a big divergence there. It doesn't feel like a market that's just going to plummet down here, to 1400. To me, it just doesn't feel like that. Now, in our members area, someone was talking about a cup and handle pattern on the much larger timescales for gold. And I just thought we'd talk about that a little bit briefly. So this is the classic pattern that is the cup and handle over here. And someone was asking whether we're in that cup and handle. So is a handle forming? And if so, how long would it take for a handle to form? And I've seen lots of kind of distortions of this kind of pattern, and there is a lot of subjectivity involved with this. And there's, again, no hard and fast rules. On this classic pattern, you've got the left lip over here. The right lip is a little bit lower, and after that, the handle forms. And for a lot of the kind of classic ones, I've seen that to be the case. And the handle seems to form, it's kind of almost like a quarter to a third of the duration of the cup. As I said, these aren't hard and fast rules. They're just kind of generalities. This is the classic, but often people find less classic ones that can kind of fit with this. But let's see how that compares to what gold is doing. And certainly we've got this rounded pattern here. But the first thing to note is that this lip over here is higher than this lip here. The second thing to note, if let's say, for instance, that we think a handle is forming, then we're looking at roughly about a third to a quarter of the duration of this cup. So we're talking at least another year. Can you see prices kind of doing this for the next year or so before moving up? Look, it's possible. Just the market sentiment and feelings just don't seem to fit with that for me. But, you know, I could be interpreting it differently. So let's see. But the other thing is that when you have a cup, there's no rule that says you have to have a handle. And a cup can be just as bullish as a handle. If we look back down here, we had a kind of rounded formation over here as well. And again, just over here, it's quite hard to see because it's all squashed down now. But price made a new high above this lip and then dipped down. But when we look at it like this, it doesn't really look like a handle as such. It kind of looks like a continuation of this curve here, doesn't it? And that's what I think is happening here. This is still within the curvature of this. And if you go and look back at my video on explosive price moves, we talked about drawing that curve, and I'm still working on it. In that video, I was only able to draw the curve of the mean of the lows. And the problem is that the lows up here will distort that curve and move it in a little bit. But I've found a way of drawing the curve so that it only fits these lows here and continues onwards. The only problem is that I haven't been able to work out how to transpose that curve onto TradingView. I've been able to do it in SPSS. So I'm still working on that, but I think that could be helpful for us. If we stand back and look at this, remember this is on the monthly scale. To me, this just doesn't look bearish. I can't see us going into a long-term bear market. Someone might say, oh, look, this is a double top. Well, if that's the case, and we broke this low here, you'd be looking at targets down here, you know. I mean, can you imagine $400 gold? It just seems unlikely to me right now, the way things are. It's not impossible, but I put that as a low probability. So I'm still plumping for a secular bull market here, and this is just merely a correction within that. How deep that correction goes is another matter. But for me, even if we just dipped down another $80 or $100, that wouldn't entice me to convert physical to fiat. That would just give me the heebie-jeebies right now. Don't know about you, but yeah. Okay, that's gold. Now, the other interesting observation that I made this week was that recently gold and silver seem to be moving in opposite directions. And that got me thinking, you know, that's pretty unusual. It doesn't happen very often. Most of the time, gold and silver move in the same direction. So let's go and have a look at that relationship. This is the chart of gold priced in US dollars on the daily scale. And in red at the bottom, I've done a correlation coefficient with silver. You can see here, when you've got a correlation coefficient of 1, that means they are moving very strongly in the same direction. They are highly correlated, and 1 is the maximum. If it goes into negative territory, that means they're moving in opposite directions. And just eyeballing it from a distance, it's really obvious that the majority of the time, gold and silver are positively correlated, and very strongly most of the time as well. You do get these dips, but Right now, we're in this negative territory over here. And that's unusual. So let's have a look at the times in the past when this has happened. If we go back to here, so that was in 2017, you can see it dipped down briefly and then came back to being positive. And that seems to mark a kind of short-term bottom at least, and price kind of rose up gradually after that. Over here, again, we had a little dip down into the negative territory, so that kind of matches up with this area here, and price started moving up after that. We've got another time here in the middle of 2019, and that correlates with this here. And interestingly, so that was the bottom of this correction here. This was kind of like a falling wedge here, and then price moved up pretty substantially at that time. These are pretty tiny dips, so I don't know whether it's worth including those really. They're quite hard to see. We've got another dip over here. Again, that's pretty small, but that seems to match with this over here, and price moved up after that. And we've got this kind of correction here. And of course, now we're in negative territory again. And actually, if you note, the duration has actually been quite long, much longer than all these previous ones. I don't know whether that has any significance. I think we'd need someone to go back and analyse things in the past. But also, I think now if you do look back in the past, you will find times where this doesn't work. But interestingly, I haven't analysed this mathematically or anything like this. This is just eyeballing it. But so a lot of the times where it hasn't worked, price has actually been at a high rather than a low. At the current point, you can see that we are at a kind of localized low here. And so again, that makes me think that there's something to this. But look, there's no certainty with any of these things. But yeah, I just get the feeling that this is. And the other thing is that this is going back towards positive. So I think it's somewhere around here now, which is another potential sign as well. But yeah, let's see. Now, that's one of the things with this channel is that I find back testing is great for picking out strengths of a particular indicator or strategy, but it's only prospective kind of forward testing that is good for finding out the weaknesses of these things. And so that's what we're doing here. I'm picking out observations, and I like to look forwards and see, what are the weaknesses, what things do we need to watch out for. We've done that a few times over the past year, and we have found a couple of things that have worked. And look, when they don't work, we just throw them out, And the other thing is that I tend to use different things at different times. I don't have one system and stick to it all the time, because what I found is that nothing works consistently on an ongoing basis. Eventually something will break. So I kind of pick and choose and, decide when to use what. So one example is moving averages. So most of the time I find moving averages are a lagging indicator. So I don't follow them particularly closely. But when I do follow them, and you'll notice that when price dropped from here, I did a video and I mentioned when we were going through this correction that I thought the target was that moving average to give us an idea of where I thought the correction may go to. But that's kind of about it, really. I don't find moving averages hugely useful for me. That doesn't mean it's not useful for you as well. That's the other thing. It's very individual. And so you just have to kind of mix and match what's going to work for you. Let's move on to silver priced in US dollars on the daily scale. And as we've said, silver's been pretty strong. Interestingly, this line remains good support at 26 again. It's just hit that, and it's amazing how quickly it just sprung back up. To me, this is a strong market, and we're still in this long-term uptrend. This trend line has not broken yet, so we'll hold on to that for now. In terms of potential downside, at most, I wouldn't expect it to go below this trend line personally. This whole market just looks like it's doing pretty well, and it would take something pretty drastic for it to go down to these levels here. So let's see. But I actually think 26 is going to hold. So I don't think it's going to even get to this trend line at this stage. And what we're waiting for is for price to hop up into the next zone here, which will be between 28 and 30. So we've still got a bit of work to do. This thing's not going to shoot up straight away in the next couple of weeks necessarily. Okay, and then we've got the gold miners. They've suffered a bit, haven't they? Oh. Anyway, I think again the pain should be getting close now. Remember, our target was around 32, but I have made this as a kind of zone, so it could poke into that zone. I still think this is going to turn around somewhere around here. I'm doubtful it's going to enter this territory again. But again, I'm just working with probabilities. There's no certainties here. Now, some people have talked about head and shoulders. So what they're saying is that this is one shoulder, this is a head, and then I guess the other shoulder could be here. But it's a bit lopsided, I think. And it just doesn't feel like head and shoulders to me. The thing with head and shoulders is that they can be fake. And we've got a classic example over here. So here's one shoulder here, here's a head, and here's another shoulder. And, you know, I mean, that looks pretty good, pretty symmetrical. But the thing is, we had this strong support over here, and that overrode everything else. This support line has held for, I think it was about 7 years or something. So it's long standing. And therefore, price just didn't even go there. And in fact, the head and shoulders didn't break down. The pattern didn't confirm. So it didn't break down below these areas here. And so, yeah, price actually shot up. And I don't know, I've just got a hunch that maybe the similar thing's going to happen here as well. This could fake people out if you do think it's head and shoulders, potentially. If we saw a break below this kind of level on this side, then, yeah, I mean, maybe that is the line to watch, you know. So that would be, I think it's the high 31s there. In which case, what you could expect if it did drop below that could go here, bounce up a bit and then keep going. But no, I'm not seeing that even in the miners, you know, the individual miners. Right, let's move on to the silver miners. This is the SILJ on the daily scale. And this is looking pretty good, pretty strong. Again, I can't see anything bearish about this. This is actually looking much better than the gold miners at the moment. Talking of those fake head and shoulders, I mean, again, here you could say there was one there. And in fact, that broke down, but that turned out to be completely fake, you know. If that was a true head and shoulders, then the target would be somewhere down here, and it just never made it. So I'm always a little bit wary of those. You know, it's worth considering and keeping in your analysis, but it's not overly reliable. And that's one of the things also to remember is that, you know, when I look at the charts, I don't just use the charts on their own, and I won't even necessarily look at one candle on its own. You've got to consider the whole scenario, every aspect of the market, and put it all together. So when I'm talking about chart patterns and all, that is going to be also affected in terms of the way I interpret it. That's going to be affected by other factors as well. Okay, so we're in the middle of this consolidation zone, and I'm thinking this is going to break out. I mean, what happened here, price actually did break out up here, but it just wasn't sustainable. It just that was just too much too soon, really. Price came down, but it actually wasn't smashed down as much as you would think. It's actually been quite resilient, so it bounced back up and is just kind of staying in the middle of this channel. I think there's quite a lot of support here at 15 now, as you can see from over here, and I'm doubtful that it will go far below that. The worst case scenario, down to about 13.5. But the way the miners are looking, I mean, I've had some of my individual miners look like they're breaking out of their patterns actually to the upside. So I'm still very positive about this as well. Yeah, so overall, I'm not feeling down in the dumps about any of this. Hopefully you're feeling the same. Well, that's it for this week. Now, I know that we've got a few Texans in our viewership here. And yeah, I'm really sorry to hear about what's been going on there. I hope you guys haven't been affected too much. That's my idea of a nightmare, freezing cold weather and no power. So I hope you're all doing okay. And for everyone, all the best and see you next week. Bye.